All right, so I'm going to record today. Like I said, I'll get the other day up. I wasn't able to access it, but Bob, our IT guy, is coming out to see why I can't get into the computer, so we're not sure. So we covered 12 and 13 last week, okay? Let's see here. 12 was all the adjustments to income. Pretty straightforward. Each one of those lines is an adjustment. Sometimes you almost feel like it's an extension of your itemized deductions. Feel like they should be on the Schedule A at times. But like I said, there's a lot of them that allow us to do things after the end of the tax year. All those things with the self-employment, the SEPs, obviously we can't do anything with the health insurance one, but the contributions to the IRA, the HSA, a lot of those things are things that, if somebody's income is such that, they're not phased out, is that we can look at it and say, okay, you owe some money. Could we make a contribution to a retirement account so that all your money's not going to the IRS, that you're keeping some of it and, saving for your retirement? Obviously, the government likes that, and till you're 70 and a half, and then they want you to take it out. But it's a way that we can do some things on there. There's a lot of those lines that, don't pertain. Like I said, with the teachers, things like that, we can't do after the fact, but there's a lot of lines and adjustments. But yeah, just realize that they're a place to look to be able to say, hey, maybe I can reduce this balance due, or maybe I can increase the refund, or, but it has to be just right. And that's where, adjustments to income are the perfect spot for the what if. You get done with somebody's tax return, pop it in what if and say, hey, I see that you have a health savings account through your employer and you didn't max out the contribution. Could we put some more into that to help you pay for your incidentals and your medical expenses, throughout the year? Or, I see that you did not max out your 401k through your employer. Do you have a traditional IRA that we can contribute to? Things that we can do to help them reduce their adjusted gross income before we get into page 2 and start applying, things like deductions and credits and figuring out tax. So.
401k, I can't remember. Can you contribute to that like an IRA, like in January for the prior year? Do you have that?
No, you really got to get it in. Yeah. The employers, just because the employers, it's got to come out of the salary and on your W-2s and stuff like that. Because if they do it and it shows up on a pay stub, because, say, okay, January, I'm going to take my entire salary and put it in, then it's payroll, with the thing. But, I had a guy the other day that, he's making about 200,000 and his wife's making about 100, at 300, even with the raised elevation of some of the stuff, they have a couple kids, on the 2018, they still phase out. And he says, well, can I make a contribution to an IRA? I said, no, because your income's too high to do it on the tax return. You guys need to, between now and the end of the year, figure out a way to max out your 401ks through your payroll. Do something to your W-2s before I ever get them in my hand. Because, the opportunities when you have that high income on the tax return, the only other thing you could do is charitable contributions. But with the higher standard deduction now, and the cap on the SALT, state and local taxes, all of a sudden his charitable contributions are going to have to be $10,000, $12,000. Well, that's great,
but you're not really getting $12,000 on the other end at all.
No, again, when we talk, it's not like it's not a dollar for dollar reducing any type of tax liability. It's just a portion, because it has to filter through before we calculate the tax or use the non-refundable credits, which he's probably going to get now because of the higher with the kids. But yeah, people with higher income, there's not a lot of options for them to do on the tax return after the fact. They're the ones that we try to emphasize, and we've emphasized all summer and fall. We need to see them. We need to talk to you, because we need to know where you're at because of the new tax code, where you're at with your itemized, because chances are, you make $300,000 a year between you and your wife, your state and local taxes on the house that you probably live in, you're going to be brought down But, again, like I talked about, as Esther calls it, the state of New York has divorced the IRS. So they're doing married filing separate now. Okay. So basically, and New York State's decided to allow a lot of things that aren't going to be on the federal, and especially on the itemized deductions. So, that's where you're in somebody that is a W-2 employee with expenses, so you're going to want people to still keep track. Everybody's kind of thinking, well, higher standard, I don't have to keep track. But I've told every one of my clients that I've talked to, no, you need to still do status quo until we get through this year and see how things fall out. Because, we don't want to leave something on the table that we didn't document that we could have used on the state or the federal. So until the dust settles and I hit that button to send it, don't change anything that they've been doing as far as keeping track of stuff. So, all right. Chapter 12, like I said, a lot of the exercises were just things, student loans, again, that's one that we talked a lot about as far as how that all works. We need to make sure that we understand that, that phases out pretty quick. Student loan interest deduction, for 17, trying to remember what the phase out was. It's pretty low. It's like 110 or something that you phase out. That's a shame. Somebody's got, especially if they've done a master's or a doctorate program, they're not getting financial aid and they're not getting scholarships. They're taking out loans if they're trying to do that. And, yep. Jim's nodding his head like, yeah, been there, done that. So, so, all right. So let's go through, we'll just go through real quick. We'll go through the quiz on 12 and just to kind of, as a refresher, because I'm sure the tryptophan hasn't worn off yet from all the turkey. All right. The other one too is, as I went by it, the one on 1239, that exercise that's there about adjustments to income and what line. Again, I kind of talked about earlier in the class, and I know some of my online students, it's hard because I don't see them face to face and watch them on the computer a lot. But this is where I tell them that, hey, take a 1040, make some notes on it, give yourself a roadmap. Because, you kind of, if you know what each line does and where you need to go and what's on that line, especially, going into that box on that line and saying, hitting F9 and going, what are my options? What can I do? Because if it takes you to a worksheet, chances are most of these worksheets, what are they going to have? They're going to have a little header, especially these ones with the IRAs and stuff, and tells you about what the phase out is, who can contribute. And like I said, that's a great place to do the what if and get in there and play with the return and see, because, some people, even making contributions because of the storm that they have with their being covered at work and stuff like that, even the IRA, if they qualify and don't phase out, sometimes it doesn't help. Or they're going to max out. And I'm like, okay, that's great. But, the last $4,000 didn't really do you any good. If you can use that $4,000 to pay down debt and save on interest with credit cards or something like that, that's probably better as long as we don't owe money at the end of the year. So, but.
The HSA is only like the high deductible plans involved.
You got to have a plan that qualifies for it. Yep. If I use the example a lot of times of the marketplace, you have to be, probably in the silver category or below, and even about half the silver plans don't qualify. When you're looking at a couple thousand, maybe $2,500 deductible per person to qualify, that's tough because, when I sat with people and talked to them about that and they have medical needs and they're thinking they can use the HSA to, cover their medical cost and pay less premium and get a little on their taxes, I have to explain to them, yes, but because of what you have going on, you're not just going to the doctor once a year for your wellness and maybe another time because you think you got the flu and maybe you got, one statin that you're taking for your cholesterol or something. You got some things going on and you're exposing yourself to a lot more big hit out-of-pocket medical, just because you think you can do the HSA to save on your taxes. that savings doesn't outweigh what you could end up paying out of pocket for your medical. You know, and that's sometimes hard to explain because, you know, health insurance is so expensive now that people see, you know, $800-900 a month. They're going, I can't afford that. You know, I could buy 3 more cars, you know, but again, I have to be devil's advocate and say you can't expose yourself to the risk.
And just because my wife has it, to get through the market, and that's what I'm doing now is looking at which plan and trying to figure out can't predict the future. That's the
and
you know.
And again, you know, that's the whole thing about insurance. And even when I'm helping people with Medicare, I mean, I can't pry and I can't flat out ask, hey, you're going to have hip replacement next year? You know, I can't do that. That's HIPAA privacy things. You know, if in the conversation it comes up, then they disclosed it, I'm fine. But if I have them, you know, they're walking in with a cane and I'm going, you know, something's going on. I hope they say something. Otherwise, you know, I'm not a, you know, my glasses are not MRI machines and I can't see, you know, what's going on. So, but. All right, so let's go through the quiz on 12. All right, Jim, number 1 there.
What entry is not found on Form 1040 in the adjustment section? A, alimony received.
Yep. And just remember, I mean, a lot of people have made calls that they're all excited because they don't have to claim alimony. Alimony is grandfathered for 18. So if you have a divorce decree and alimony payments that are already set in stone from a decision, you know, the divorce, the finalization, you're still going on as status quo. You know, the non-received and non-paid is for things that are happened in 18 and going forward. So, and I haven't really heard, I'd have to do a little more research, but I haven't really heard if redoing the divorce decree and changing it or whatever, if that grandfather's in. I'd have to do a little more research on that one and see how that works. So, all right, 2, Marianne.
Which one of the following statements is not true concerning the educator expense adjustment on Form 1049-23? B, qualifying expenses include expenses for homeschooling.
Yep, and that's one too that there's a lot of people, and I have a couple clients that do a lot of homeschooling with their kids, and that's one that they're trying to get changed.
Yeah.
You know, there's a lot of lobbyists for that because, you know, if they're a teacher at home,
that's the difference.
Yep.
They still hang
Exactly.
a shingle over there in a building or a home.
Exactly. Yep. You know, and that's where it's going to be interesting to see how that one works out. So, all right, number 3, Jim.
Qualifying tuition fees include all the following except which expenses? C, room and board.
Yeah, and almost the biggest cost anymore. And I think it's been fascinating with my kids in school. I can't believe how far past tuition room and board is. So it's amazing. Amazing.
Student loan interest can be taken as a deduction only if certain rules apply, which is not a rule that's necessary for taking the adjustment. B, the taxpayer does not have to be an eligible student.
Yep. You know, it's kind of like the lifetime learning. We got a lot more latitude. So, all right, number 5.
In order to claim the moving expenses as an adjustment on Form 1041-26, which of the following statements is not correct? C, there are no exceptions to answer A.
Okay. All right.
Other way.
Yeah, sometimes, you know, it's an art writing questions on a quiz or exam, isn't it? I can't remember if I brought it up about moving expenses when we talked, but moving expenses are going away for everybody except military. So that is one of the changes that did happen from 17 to 18 on adjustments to income. So on that one, you know, when they talk about, you know, taking moving expenses, you know, it even says on the new form that right on the line for adjustments on that postcard that, you know, for military personnel. I forget how it's termed. Let me see here. I think I still have that with me. Let's see. Yep, adjustments to income on postcard schedule 1, line 26 says moving expenses for members of the armed forces attached form 3903. I haven't seen 3903 yet, but that is a little subtle change that happened with the adjustments. Okay. All right, number 6.
Okay, which statement is true concerning the adjustment to income for 1/2 of the self-employment tax? B, 1/2 of the self-employment taxes. Adjustment for the taxpayer who is self-employed.
Yep. Again, basically, you're getting the benefit that an employer would. Okay. Number 7.
7, penalty on early withdrawal from a savings account would be found in which form the taxpayer provides? C, the 1099 INT or OID.
Yep. And I can't remember if I said this too with the interest. A lot of times you'll see these OIDs and stuff like that. If you've looked at the Schedule B close, they show up as negatives or adjustments to interest income. Okay. They cannot, a lot of times you don't have to report OID because you cannot go negative on interest earned. So OIDs a lot of times are something that you can take against other interest. So say that you had a mutual fund or something that had bond interest and you earned $1,000, okay? And your OID is $1,500. Well, by right, you can take your OID and subtract it out, but you can't go negative. So you either have to adjust that OID or, sometimes you just leave it off. So
What does OID stand for?
original issue. Okay. All right. Number 8.
Miscellaneous income that is more than $400 is entered on which form? A, Schedule C easy or C.
Okay. And what's the threshold to issue a 1099 miscellaneous?
600.
Yeah. That, and those are two numbers everybody always gets confused and that don't line up. You're thinking, okay,
That's right.
well, if I make more than 400, I got to do Schedule C, but nobody's going to issue me a 1099 unless I made more than 600. The moral of the story, if you have self-employment over $400, report it. It doesn't matter if you get a 1099 miscellaneous or not. You're still obligated to report it.
Nor do we have to give a form if it's less than 600 for interest, like mortgage interest. You still have to give a 1098.
Yeah, you still should if you have interest income.
Less than 600.
Yeah, because remember the threshold that it's not reported is $10 for interest income. So, but again, you should report it. Because all it would take is, scrutinizing over something else. And if they come back and, find out, well, where'd you do with all the interest you earned holding this mortgage? So, but, as long as you're reporting it and you know where it came from, you're fine. So, all right. All right, number 9, Jim.
Choose the type of IRA that is not an adjustment to income on Form 1040. B, the Roth.
Mm-hmm. And, yes, go ahead.
Is the Roth, so basically, coming and going, putting it in and taking it out is not included in taxable tax.
It doesn't really do anything on the tax return.
Return
No.
period. You
Yeah.
don't have to claim it at the end or.
Well, you've claimed it because somewhere along the line you used income that you had paid tax on. So it's somewhere in the return, but it's not. You don't see it on a line that shows up. You have to report it. Like I told you the story about the gentleman that was contributing to his wife's Roth IRA. Didn't think anything of it because he had the same mindset. Well, I don't have to do anything with it on the way in and doesn't do anything on the way out. But because of how his contributions to retirement working, that money going into the Roth, you still report because it became excess and he paid a 6% penalty every year that it was in there. And then he had to correct it and recategorize it, and then it became income. So yeah, you just got to be careful with Roths because, on that IRA worksheet, the bottom section, you still put the Roths in there, even though it really doesn't do anything. You still have to because otherwise you could end up with excess contributions and a penalty that.
So if you're.
So.
When you start pulling out on the Roth, you don't have to show that as income because you already paid the tax on it. But what about the interest that's been built up there?
The interest, the growth on it?
Yes.
Sometimes that's taxable.
Sometimes.
All right. So that, do we get through 12? No. 10. Who's got 10?
Taxpayer may not make a contribution to an IRA if he or she has reached the age of 70 and a half by the end of the tax year.
exactly.
You no longer have to contribute.
Yep. And like I said, the 70.5, in the year that you turn 70.5, make sure that you understand that you get until April 1st of the following year to get your RMD done. In a year after that, you have to have it done by December 31st. So they give you a little bit of a grace period, if you will, in the year that you turn 70.5. Okay?
But if you're retired before that, you can't put in an IRA anyway. Once you're retired, right? You can't contribute to an IRA.
No.
You're not having earned income.
Mm-hmm.
That's provided that you're still working at 70.5.
Yes.
Okay, got it.
Yeah.
So even if you're working and you're still working at 72, you still can't put in because you're over 70.5.
And two, when you
Unless you have a spousal, right? Then you could.
Well, if you read the about RMDs and the tax code, the thing that's interesting is it's not a black and white, because most people have the idea that when you reach 70.5, if you're still working, you don't have to do your RMD. But there are some employer plans that do require you to do the RMD even if you're still working. So again, it's not one of those that's 100%. If you're working after 7.5, you don't have to do your RMD, because some of them are, again, the way they're set up, because there's so many different, retirement type things. So, sometimes I tell people, well, yes, you are correct, but because you're asking about something that is employer, you need to ask them, are they requiring? Because that might have been something you signed off on. Again, I go back to the little, do you scroll through and read the whole thing, or on the you just check the box says accept and hit next so that you can get it done. So, you have to read the small print, kind of like we talked about with student loans. So, all right. So that's 12. 13, you got into a lot of the top part, the headers of our Schedule C. One thing we did discover with the 18 software, remember we've been talking a little bit, the fact that there's going to be a pass-through that's going to be that 20%. Not all self-employment is subject to that. There are restrictions for certain type of professions. And what we found is on the Schedule C, it is driven by that business code number. So remember the ones that are listed in your book, there's a little bit, but I showed you how to go on the internet and do that NAICS code and put it in there. You got to get it accurate, because if you don't, and the code is, you put it in a code that maybe restricts you from the pass-through, you might not see it on the return when they would be eligible, and vice versa. If you have them have a code that is subject to the restriction from the pass-through, but they're really in a profession that would make them eligible, then you've cost them 20%, as far as income, that would be tax-free dollars on their net income.
Medical is not 20%.
Mm-hmm. Yeah, there's certain professions, sometimes it's surprising when you start looking at them. Yeah, a lot of service type, professional type things. They talk about lawyers and accountants and engineers and things like that, some of those type things. So, hold on, let me pause here.
How you doing?
All right, so we have, oops.
He does lectures with Esther.
Yes,
Yeah.
the radio and stuff like that. Yep. Yeah. All right, where did I go here? Okay, so that was 12. 13, like I said, was we were talking about the header. Very, very important for 18. Very important, just because of the way the software is going to work. Okay. Expenses, same thing. Making sure. I did a little plug for our I got to get off that one. I don't know who got me on that. Somebody was using my phone for something, and now I get Checkers deals all the time. Hey, today, 99-cent hamburgers. That's great. That sounds real appetizing. So, yeah, well, that's, I'm fascinated. My granddaughter that's going to be, 8 months old, and just watching her, it's like it's genetic now. My grandson that's, he gets so frustrated with me when I'm trying to find him a show on Netflix or Hulu or whatever. It goes, great. Papa, no. You know, and then the other night he goes, Papa, this is, you know, kind of like as a teacher, and he's clapping his hands together at me. I'm going, okay, I get it. Here, you do it. You know, he's not even 3 yet, and he's like, here, you know, so. You know, expenses, again, little plug for the app. Keeping track, you just got to keep track of things. Obviously, it's very easy if you write a check or credit card charge for expenses on self-employment, we can go trace it down. You know, but if you're going to rely on that in an audit, I would encourage to at least have a separate checking account with a debit card and doing a DBA. I mean, it doesn't have to be a true credit card, but something that allows you, if you have a high volume of transactions, that it's easy to find, okay? Because, you know, if you're in an audit, oh no, I'm just using my personal account. Okay, well, that receipt that you're claiming, do you have the actual receipt to show us that everything purchased was for the business? Or, you know, did you buy, you know, you went to Best Buy and you got a new router, but you also picked up, you know, a couple DVDs for Christmas and whatever else, you know, so you got to make sure on that. You know, checks, again, canceled checks are always great receipts. Obviously, the tough one's cash. You know, you got to keep track of the cash ones, you know, because how many businesses are cash businesses? So both on the income and the expenses, you know, keeping track of those, okay? Most of the time when you do a Schedule C, the biggest expense that you're going to be claiming is your mileage. And that's one that they will scrutinize, especially New York. I think I've told you there's several instances where they scrutinize it. You know, okay, where's your tax home? Well, you know, this guy lives in a horse stall. No, he doesn't. He lives in an apartment. Here's his office. Okay, you know, type of thing. Okay, so make sure. And then always realize too that once you have a net profit, you know, you can probably use, if you do have a business home, okay, and I encourage you to really talk to people about using the simplified method. You know, getting into the utility bills and the repairs and the mortgage interest and the property tax, and then taking a percentage that is the square foot of the home. Yeah, you know, it's just like mileage. You can keep every gallon of gas, every oil change, every insurance payment, but, you know, standard deduction and make sure it's a legitimate area. Okay. Well, yeah, I got a 3rd bedroom. Okay. You just called it a bedroom. You didn't call it a home office. Well, yeah, but, you know, well, is it a bedroom or is it an office? Well, the bed's covered in papers. I'd call that a filing cabinet. No, it's a bed. Okay. You know, and, you know, always find with some married couples when she'll look at one of them will look at the other and say, yeah, I'd like to have my dining room table back. Can I declare it as a home office? Because we don't get to sit at the dining room table because it's covered in business papers. So, all right. Yep. That's, you know, and that's where, you know, so, and for some people, yeah, their dining room table is their home office. So they never sit at to eat. They sit with a TV tray. All right. So we have all that. And again, self-employment tax. People have to understand too, a lot of times they don't realize with self-employment tax, when it's calculated, it comes into play on the 1040 page 2 a little later on. It's not there to get eaten up by those refundable credits, or excuse me, non-refundable credits. You can maybe eat it up with your, you know, if the spouse is working as a W-2 with what they paid in, or if you have the earned income credit or the additional child tax credit, you know, you can eat up your self-employment tax. But those non-refundable credits that we usually use to eat up our tax bill, they come into play before the taxes there for self-employment. Okay? So a lot of people get caught off guard with that. And self-employment, you know, somebody's making $10,000 profit, they better be making estimated quarterly payments, okay? Because if they're not, then there's a good chance that they're going to have a penalty at the end of the year because the IRS is going to say that they did not receive their income, or excuse me, their tax payments timely, as the IRS likes to say. And my usual response is, well, you're not giving them the refunds timely, so why should they pay you timely? So. All right. All right. So let's go to the quiz on 13, and then we're going to delve into the world of depreciation.
Just a quick, statutory employees. I understand the insurance salary works out of their home, but is there many other? You give the example of drivers, Delivery drivers, is that?
You know, truck drivers?
Yeah, it's like,
Well, it depends on how they're set up, how their payments and stuff are set up. So, because sometimes, you know, the statutory applies to them, sometimes it doesn't. You know, basically statutory, it has to be set up a certain way as far as the industry that they're in. And like I said, the best of both, it's kind of the best of both worlds. Because on your pay, you're getting the Social Security and Medicare taken out. So you're not subject to self-employment tax because you're paying it out of your income. Tax withholding is optional, you know, just like anything else. But you get to take your expenses on a Schedule C, which for 2018 W-2 employees, that's huge. Because W-2 employees in 2018 can't take their business expense deduction. That section's gone from the Schedule A. So if I'm a non-statutory employee on a W-2 and I have job expenses, I can't deduct them in 18 like I could in 17. Oh, yeah, the ones I can think, I got 3 or 4 clients that work in the airline industry, flight, and they, you know, they know what goes on that 2106. It's gone.
Will they know that, or how will we know that?
As far as,
Let's say someone comes in that you're a repeat customer.
Mhm.
And we did it last year,
Mhm.
2017, we took that.
Mhm.
Now you came in with the same information.
I have to look at them and say, well, we can't use this.
So we would have to know that.
Yeah.
Then they would have to know.
Mm-hmm. Yep. Yep. Because they're going to look at it and they're going to go, what? And the other thing too is, you know, even with the 2% and the higher standard deduction, it may have been the case that even if we use the old rules, because of the higher standard deduction, it might not have made a difference anyway, because they might not have had enough job expenses to itemize anyway. So, you know, that's going to be something you'll have to do, is make sure you say to them, you know, hey, you know, if it would have been on there, you know, and we would have been subject to the 2% rule, then, you know, you wouldn't have got to take it, because your standard deduction for married filing joint now is $24,000 instead of $12,700. So if their itemized the year before was only 19 for the 2 of them because of their job expenses, they're not going to get to use it anyway unless they decided to give an extra $6,000 to the church to try to get over 24. So, yeah, but yes, there's going to be some upset people. Unions. I'm surprised there hasn't been a bigger stink raised with unions, especially for the trades, you know, steam fitters, electricians, plumbers, you know, because a lot of their pay is based on exceeding that 2% threshold to be able to itemize their union dues because of what they pay to the union for each job that they do. You're not going to be happy campers. All right. Quiz, chapter 13. We're on page 1334. All right. Marianne, you want to start off this time? 1?
Sure. Which of the following is true about Schedule CEZ? D, Schedule CEZ can be used to report income and expenses for statutory employees.
Mm-hmm. Yep. All right. 2.
which statement is false regarding the cost of goods? See, labor costs are not part of the cost of goods.
See, I don't like questions like that there's something that's false and then there's not in the, yeah. That one's always, that always tough for me. I don't like true false questions either.
Yeah.
Yeah. I guess I'm too believing of a person that whoever's saying what they said is being honest. 3.
Which statement is true if a taxpayer has 2 or more separate and distinct businesses? B, a different accounting method may be used for each business as long as each one clearly reflects the income of that business with separate books and records for each business.
Okay. And in that case,
Separate Cs also.
exactly. Yeah, I was just going to say, if you look at number 1, combine all income and report all expenses on one Schedule C. No, especially for 18. Why? Because one profession could be not subject to pass through and the other one could be. So, you know, you can't just lump.
Would be and I would not.
Exactly. Yeah. So you don't want to lump everything together on one seat, especially for 18. Okay.
You couldn't before anyway.
No, you couldn't before, but you know,
Separate entities.
exactly. But you could really hurt yourself in 18 if you were doing that and you ended up putting it all in the industry that's not subject to the pass through. You could really hurt your tax liability. So, all right, Jim, number 4.
Which one of the following statements is true? B, expenses for the business can be deducted in Schedule C.
Okay. Number 5.
Which is not an accounting method. C, depreciation.
Isn't it?
No, but I don't want to get that hybrid thing anyway. Though.
Yeah, I
One or
know.
the other.
Make up your
Not
mind.
blended, I know.
Make up your mind.
Confusing either one.
Yeah, Mary Ann's a black and white person. She doesn't like this whole gray stuff.
No, I love my gray stuff, but I like to simplify.
Okay.
It's different.
I just don't like those ones that they give you 9 rules that sound like they're set in stone, and then you get to number 10 says, no,
Except, yeah.
1 through 9 you can,
Right.
are void because number 10 is true. Well, then why'd you give me 1 through 9? So, all right, number 6.
6. To account for inventory, the accrual method of accounting must generally be used for purchases and sales.
Okay. 7.
Okay, when preparing a statement of income and expenses, attached return, one must keep books and records for a specific interval of time called an accounting period. The annual accounting period for an income tax return is called a tax year. Name the 2 accounting periods recognized by the IRS: calendar year and fiscal year.
Yeah, and again, Schedule C's, you're going to see calendar because it coincides with their personal return. So fiscal is very rare, and it sometimes shows up on C or S corps depending on the business cycle of the business. Like I said, if somebody just can't get it together and they're a landscaper, or say that there's somebody that does snow removal. Well, if they just can't get together, then maybe, if they have an S corp or a partnership, we should have them on a fiscal year so they can do their bookkeeping and get their tax prep on a downtime.
It's not when they open up the thing. It's like when we started an S Corp with our therapy group at
Mm-hmm.
one point, we started in November, so that was our fiscal year.
Well, that was your year that you incorporated. You can still do a calendar year. You're just doing a partial year return. Yeah. So unless you declare a fiscal year that you're going to go from the date of the business starting, everything kind of defaults to calendar. Fiscal is not automatic just because you didn't open it January 1st. Everything usually defaults to calendar unless it's signified otherwise. So, okay. All right. 8, Jim.
Which form will be issued to the taxpayer with totals of gross merchant card and third-party network receipts and sales? C, the 1099-K.
Yep. And again, those PayPal, I always use the PayPal example because that's got to by month and somebody's income that's doing internet or e-commerce. They're going to get a report from whoever's processing the payments. Even sometimes, I don't know if Square does them. I can't remember. Square, you can pull the stuff more so off of the most of my clients that I have that have Square, they just give me the password and I go in and get the information off of the Square account. So, they don't really have a 1099-K per se. So, all right, number 9.
The statement is false with regard to statutory employee. C, statutory employee is issued a W-2 and the income is reported at Form 1040, line 7.
Okay. All right. Okay. All right. So that is chapter 13. Okay. I'm going to hold off on questions about the problems till we get in and do some. Okay. So the problems that you did for 12 and 13, we'll kind of do that when we do the problems. We're going to go through 14 first, and then we'll do a bunch of problem work and kind of look at some of the from the workbook, because a lot of them, 12 is pretty much okay, but 13, 14, they kind of build off of each other. And I'd rather have it so that we can kind of tie it all together rather than individual, so that we can kind of add things to the problems as we go along. Okay. All right. So let's get into chapter 14. Are we ready?
Yeah.
Okay. They gave you some doozies. Chapter 14 has depreciation, business use of the home, clergy, self-employed health insurance deduction, and self-employment tax. Not like they couldn't throw you just, they dropped a whole ton of bricks on you there, because all these have these little nuances that just, unless you've partaken in them, sometimes you're going, what did I just read? What did they just say? Okay. As it says there in the introduction, Depreciation is an income tax deduction that allows a taxpayer to recover the cost of or other basis of certain property. It's an annual allowance for the wear and tear, deterioration, or obsolescence of the property. Okay? Depreciation is a fancy word for an expense. That's all it is. Okay? So when I buy something for my business that has, we'll talk about its useful life and its cost and stuff like that. Basically, what I'm doing is I'm trying to decide when I want to expense that purchase. Okay? And I tell everybody, if we're in a startup and I have to buy a bunch of things, why do I want to waste an expense in a year that I may not have income? Especially if I started my business in November. I maybe have not generated income. I want to push it to later years when I can use it against income I've generated. All right. Yes, you can take the loss and it may be limited, and then you can carry the loss forward, but it makes a little more sense to use that item as an expense for all the years that it's generating income for me. That's all we're doing. Okay. You're going to get in here and they talk about special depreciation, the 50% or the section 179. Basically what that is if I have a business that I started and in the first year I had a whole bunch of income, well, I can minimize that taxable income by front loading my expense and choose to take half of it or all of it, depending on what it is, in that year. Okay? So basically, depreciation is a nice thing because I get to take my expense and decide when I'm going to use it. All right?
If it wasn't for the tax law, depreciation in a business wouldn't have.
Well,
I mean, like I don't, for my car, I know it depreciates.
as soon as you drove it off the lot.
But it doesn't affect anything. I don't keep track of it. All I know is how much I paid for it at the beginning and what it's, when I go to trade it in or sell it.
Yeah, but depreciation, like you just said there, really in an instance like that, because you're not expensing it anywhere as far as your business or your household or on your tax return or anything like that, it's a way for them to justify the value when you bring that car back. Does depreciation take into account that, you have an impeccable record of keeping maintenance on it and everything like that? No, that's kind of the blue book. They take a look and see what the value would be, if it's in excellent condition or whatever. But still, that number is within the range of depreciation. Because what have you done to the basis of that? You've decreased the basis because of the, of things like that on it. So, okay. So really, that's what depreciation is. Okay. There's a whole bunch of forms. Like I said, we're going to be coming back to some stuff we talked about earlier with capital gains, about selling things and trading them and stuff like that. That, you're going to go, especially the next chapter, even more so with, when you're selling rentals and recapturing depreciation and stuff like that. Okay. All right. So basically what happens a lot of times when you get rid of or dispose of a capital asset, your depreciation that you've been using all of a sudden becomes income. Okay, because what happens? You have to add it back onto the basis because you've used that expense or that depreciation as tax-free money all those years. And now the IRS says, okay, time to pay tax on that income at the end when you dispose, especially rental properties. They're basically saying, hey, now you got to pay tax on it.
Well, what happens if it finishes off the whole entire depreciation?
If you have a rental,
No, I'm talking about some of the equipment, let's say 7 years, furniture, the desk. Let's say, because I'm going to dissolve my one office.
Mm-hmm.
So my desk and all that I made and depreciated over the 7-year period.
Mm-hmm.
Well, I've been practicing for 30-some years.
Sometimes there's still
Now, do I pay
recapture.
that back in?
Sometimes there's recapture on them, yes. Unless you if you sell that. Okay, so if you sold the desk,
Okay, what happens if I don't sell the desk?
and they don't sell the desk, then they're just no longer in service.
Oh, if I sold the desk, see where, well, now there's money.
Yeah. So that's where you have to put that against it.
Okay,
So,
same thing then with rental. So you own the building for 50 years. And it's only 27.5 or whatever, isn't it?
But that's where it's generated that income on that when you sell it, because you're selling it. That's why a lot of times when people are reaching that 27 years on a property they have, what do they start doing a lot of? Renovations, more capital improvements. Because all of a sudden they're realizing that they're losing that deduction for depreciation, and they remodel a bathroom, or they put a new roof on, or they do siding.
It adds to the principal.
Well, you know, it adds to the basis and stuff like that, but it becomes another depreciation, because a lot of those things can be, you know, a new roof. Exactly. So then they still have that. Otherwise, when you're done depreciating, then your rental income or your business income becomes taxable. You know, you don't have that expense of the depreciation to put against it to reduce taxable income. So that's where you see a lot of people, or they'll make that purchase. Yeah, you know, I guess I better buy a new mower this year. You know, and I see a lot of times with people with farm equipment. They're always buying, you know, new tractors. Because when the life of the tractor that they have, time to buy a new tractor, need that expense to put against the income. So, okay. Jim looks puzzled.
Yeah. I mean, I'm just figuring that you still need them.
But again,
you don't just go buy a tractor so you can get depreciation.
yeah, it's not like that's something you have to do to keep that, but you have to realize that once you've used up the useful life and the depreciation time frame, or whatever you want to call it, the years or whatever that you've used to depreciate, then all of a sudden you don't have that line item expense deduct to put against income, makes more of the income taxable. And like I said, that's where, you know, people will do something, especially on rentals, to add to or start a new depreciation. Because then they keep that depreciation line item up as opposed to just letting it fade away.
Kind of a Ponzi scheme. Right? I mean, well, really, you just keep adding at some point, but I mean, you just worry about today for this year.
Yeah, and again, you know, just like we talked about when we talked a little bit about the 1031 exchange and things like that, stuff that you do like that, and with depreciation, you're basically trying to kick the can down the road on income with this depreciation or like kind exchange to not have to pay tax on it. You know, put it in the future so that you stay away. And, you know, some point maybe there's a year or a situation, or because you retired and your income is less, that all of a sudden it becomes a good idea to dispose of things because you kicked the can down the road, and now when you have to declare that capital gain, your tax bracket's less.
That's why my personal car, which is paid for and has a lot of miles on, I'm not interested in buying another one yet, but I don't want the payment. But if it was business, I might be, because it would save me money.
Yeah, you know, if that business was strictly, or that car was strictly for business, yes, it might keep your taxable income down. Mm-hmm. Yeah, you know, and again, you know, with things like that for businesses, you know, you got to be a pretty good sized business, a pretty good income flow and cash flow to use that philosophy. You know, building birdhouses and deciding to buy a new truck every 3 years to get depreciation for your birdhouse business might not be a good financial decision. And that's why I say I use that analogy with the rentals more often, because, you know, chances are you're holding that rental for a longer period of time than you would, you know, something that you have in a small business or a Schedule C. So, okay. Property required for use in business, at the top of 14.4, with an expected lifetime of more than a year, generally cannot be expensed in the year acquired. There's that word generally. Basically, we should just put in parentheses behind it, gray. Okay. All right. So generally, instead, the depreciation is a tax deduction that allows a taxpayer to recover the cost or other basis of the asset over its useful life. Now, there are times that we can take, and a lot more things in 2018 are qualifying, the term I always use is to front load. Push all of the expense and depreciation where I can make an election to take it all in 1 year early, okay? And sometimes there's a special one that you can take 50%, okay? The big thing is when we get into the problems and we do some and we make sure that we get the right category so that we know that it is eligible for special depreciation. Because we can't just say, oh yeah, I bought this $2,500, plow for my truck for snow. Well, we got to make sure that the category that it falls into allows us, if we want to take it, because you know what? I just got the contract for Walden Galleria and they paid me up front for it. Well, I'm probably going to want to take a lot more of the expense that I can, but is that something I can do that? Can I elect to do that? Okay. All right. And again, I don't get caught up on the word depreciation. I want you to make sure that you understand that it is an expense, and we're just trying to figure out how to cut up the pie and when to use it. That's all I want you to think about it as. You start getting into the whole, we're going to get into MACRs and ACRs and acronyms and this and that, and then you're going to go, well, wait a second. If I do, is it mid-month, first quarter, half year? So, well, that's because it's gray. I think, maybe I should have them next year write the textbook and just in the paragraphs that are like that, we'll highlight it in gray.
But if it's gray, why can't it be my gray instead of your gray?
Well,
Because half year, they say midpoint.
I think, Marianne, you need to run for political office next time that they try to do tax code review. So, all right. So MACRs, there's a couple different things. MACRs is basically what we're going to use. You'll see in the software you have, a lot of CPAs will use straight line, which means that it's just a set amount. MACRs, what it really does is, again, kind of helps you front load a little bit. There's not as much in the first year, kind of here and then spikes up and then kind of levels off, especially when you look at rentals, okay? And again, the MACRs helps us too, is depending when we bought it as to how much we get in the first year, all right? Again, Marianne brought up her business starting in November. Well, if I have something I'm going to depreciate, I don't want to take and just do a straight line and take a whole year's depreciation maybe when I didn't need it. MACRs allows us to, prorate, if you will, in the first year, and then the second year might have a little bit more, and then it kind of levels off.
Can you do a quarter on that
Depends.
one?
So it's great. I can't make any yes or no answers for you on this. So, talks about computing depreciation, date placed in service, very important. Okay, because we have to know when that's going to be done, and again, it's when it's placed in business. Okay, I think we had the discussion about furnaces, buying a whole bunch. If you bought 5 or 6 furnaces because you could get a deal, when do you expense them? Well, if they're going to be put in service for business, really you can't expense them until you're actually using them for the income generation. If you were in the business of furnace installation, well, then they're inventory. But you're not in that business, you're in a landlord business. So I have to kind of wait till I put them in service.
Same thing with hot water tanks, things like that.
Yeah. When did you put it in service? As it says here, depreciation begins when the property is placed in service. This means it's ready and available for specific use, whether in a trade or business, the production of income, a tax-exempt activity, or personal activity, regardless of when the property was purchased. Again, date placed in service, okay? That's when we have to use it. Because there's a lot of times people will buy something and maybe, I didn't see any Black Friday deals on hot water tanks. Was there any? I didn't really check out Home Depot or Lowe's, but.
North Scratchington.
Okay, all right, that floor models. So, but those are the things that, yeah, maybe I bought Black Friday, but when did I put it in service? Well, the other one went out in February of the next year. That's when it becomes in service for my income generating property or my income generating business, okay? The basis of the property, talk a lot about that. When we talk about 2 with the basis of that furnace, what else could we have on the basis? What adds to the basis? just the installation. Yeah. Yeah. So you can do that. The tax, the installation. You know, I don't think there's any special license you have to have for a furnace, but, you know, if you have to, you know, type of thing. So, all right. So, yeah, it depends on the inspector too.
Inspect, right.
Okay.
What about if you require
Yep.
the license stuff?
All right. Property class, we're going to talk about that when we get in there, but, you know, each one is based, there's a little chart that we'll see here shortly that talks about the recovery period. The recovery period is the IRS-defined number of years over which the basis for an item in a property class is to be recovered, or the number of years until fully depreciated, okay? And again, very important, all right? Depreciation methods, Mackers implements two methods, declining balance method, an accelerated method established in Mackers to depreciate property. The general depreciable system uses either a 200 or 150% declining balance percentage, depending on the property type. Again, what I just read, Jim's going, yeah, that's great. What is that? What did he just say? Okay. Again, how are we going to front load it? That's really what that's saying. Okay. You know, because if I take and look at straight line, kind of makes sense, right? You just take the pie and you cut an equal number of pieces.
That's why we don't use it all, because it makes sense.
Yeah, why would we use anything? Well, but again, you have to look at it when, you know, one is my depreciation most advantageous, okay? All right, so it kind of shows you, you know, the rates and stuff, gives you a couple examples there, okay? All right. Talks about depreciation systems within Mackers or makers or whatever, you know, I'll call it makers, whatever you want to call it. It talks about the GDS and ADS systems there. Okay. All right. A little bit of a depreciation method there. As it says there, if you look at the benefit on the right, see where I was talking about, if you use that GDS using the 200% DB, provides a greater deduction during the early recovery years. So again, you know, if I'm a landscaper and I bought a mower and I'm hard on mowers and I know that I can take it for 5 years, but every other mower I've owned has done what? Died in 3. You know, so that I can use that and get my depreciation on it. Sometimes I want to do a special or use this method so that I push most of the depreciation or the expense into the early years. Okay. All right. Okay.
In general, if you're just starting a business, you usually want to push it further out, just because you, for the first couple of years, you're probably not going to be making as much as once you get established.
And again, you know, yep, startup. You know, if you're a startup and, you know, you hope that you make money the first year, you know, because last thing you want to do is shut the doors at the end of the first year. But yes, you know, and it depends on the industry too. You know, sometimes people get into a business and whatever they're doing, they may have clients where they sign a contract and they get most of the payment up front, you know, a retainer or something. And so again, it depends on the business and the industry, okay? You can see there that the recovery periods on the top of 14.8 talks about all the different years on different things, okay? You know, most of them 5 years, you know, 7 years on some office furniture. So yes, after 30 years, you fully depreciated your office furniture. So, okay. All right. And now it's starting to appreciate because now it's considered antiques and there's valuables. So now you.
Each item you get to pick what method you want, basically.
Yeah, again, you know, pretty much what we use is the makers and the shorter life. Because again, you know, most of the time people do not, based on the guidelines, do not reach the useful life of something. You know, and it goes, I guess it goes back to the whole thing when, you know, mom and dad, you know, grandpa and grandpa say, boy, they don't make washing machines like they used to. Well, you know, some of this might be based on when washing machines, you bought one when you got married and, you know, you moved grandma and grandpa out of their house and they still got the same washing machine they got when they got married. You know, now you buy a washing machine and you hope it lasts 5 years. So, all right.
That's why I think they should change some.
Make a note there that that's one of the things you're going to do when you get elected.
It should be
I'll
an
vote for
average
it,
of
Mary Ann.
3 to 5 years, depending on the quality.
You know, if you want to get elected, you got somebody that's got an inside track. He can probably help you out with those ballots.
I can send that to you. You won't even ask to see their license.
Yep. They trained him in Florida. All right. Conventions. Again, now we're just throwing you know, we have to decide when our recovery period begins and ends. So now we're throwing on top of it our whole conventions. Is it half year, mid-quarter, mid-month? Okay. And again, just because the time of year that we buy it doesn't necessarily means it falls exactly in one of these, especially when we look at the mid-quarter, because then we have to look at not only the one item that we bought, but the total ones that we bought. Okay. All right. So we're going to use our little example here. Okay. My phone's still going off. It's not Cyber Monday. I got to get rid of some of those shopping apps that somebody put on my phone. All right. So during the year, Tom Martin purchased the following items to be used in his rental property. Okay. Again, we're a little ahead of ourselves because rental's next chapter, but this is a good example. He elects not to claim the special depreciation allowance. And again, says we're going to discuss later. So he bought a dishwasher for $400 in January, or placed in service, excuse me. Used furniture for $100 he placed in service in September, and a refrigerator for $800 that he placed in service in October. Okay. Tom uses the calendar tax year. So the total basis or value of what he bought was $1,300. And you see where that came from, correct? Mm-hmm. The $800 basis of the refrigerator placed in service during the last 3 months of the tax year exceeds 40%. Therefore, Tom must use mid-quarter convention instead of the half-year convention for all 3 items, okay? So basically, with conventions is basically, if I just buy one thing, you know, the software will kind of do it for you, get you in the right mid-quarter or whatever it is. But if I have more than one item purchased, you know, and again, if I have somebody that comes to me as a rental property and, you know, they bought a refrigerator in January, but they did a $5,000 bathroom renovation in November, you know, what am I going to have to do? Well, because of that 40%, things are going to be all pushed, and it kind of, because it's where it's weighted to, if you will. Okay.
So if it was reversed and the furniture was the October, and it's only 100, and the refrigerator was, or the dishwasher was in January, you wouldn't have to do that.
Mm-hmm. Because you didn't wait enough at that, you know, you didn't wait it enough at the end, if you will. So, and again, you know, depreciation is weighted as to when we actually incurred it, or when, again, I keep using the word incurred, I should say that it's placed in service.
So the dishwasher was in January, right?
Because of the weighting of it?
There's no full year?
No.
That's all I need. No full year, so no matter if it's January 1st, it's still half year.
Mm-hmm. Yeah, because if we go back up, it says half-year convention treats all property as if it's placed in service at the midpoint of the year. Half year is used for most property except property subject to mid-quarter. Okay, so again, first 9 rules apply, but rule number 10 says forget rules 1 through 9. Okay. Mid-quarter used if the total depreciable basis of Macker's property placed in service during the last 3 months of the tax year is more than 40% of the total entire year. Mid-month used for residential rental property and non-residential real property. So when you have purchased a rental property for 27.5, it's going to be mid-month. Most of the stuff's going to fall mid-month for that. Okay. All right. And they do a little bit of residential rental, but we're going to talk about that in the next one. Depreciation, one thing is, what can you not depreciate?
Land.
Land, okay? So usually we use a rule of about 10%. So if I bought something for $100,000, you know, a house sitting on a piece of land, take 10% off, and then I adjust the basis. And again, we'll see that when we get into the forms, okay? All right.
That's a little lean now.
What's that?
10% is a little lean.
Yeah, it
Land
depends.
can be very expensive. Sometimes it's more costly than the house itself.
Yes, it can be. But, you know, if you know it, and that the land was that portion, then you can adjust your basis. You know, obviously, if you have record and supporting documentation to show that your land has a certain value, then yes, you can take that value. You know, for most of the times, you know, when you get a closing statement buying a house, do they separate out what the value, the appraised value of the land and the house is? No. But if you're buying a piece of land first and building something on it, then yes.
Like a house in the city of Lockport, it's basically the land is size square foot of the house. Right? No, I mean, it's,
I'm thinking more like we do.
yeah.
Yeah.
Some of the pieces
Yeah,
of properties, and you have to have so much anyway.
Mhm.
That's $65,000-$75,000 just for the property,
Yeah.
just for the land.
Because, you know,
And
it
then if you put a
depends.
$150,000 home on it.
Yep, and it depends on the moratoriums too, because, you know, if you think about, you know, Clarence did it for a while where they put a moratorium on developments. So you had to buy and build a house non, you know, community or whatever on a certain size piece of land. Well, you know, you had to get a pretty good sized piece of land so that you weren't considered part of a development. So, and then they shot themselves in the foot because all of a sudden they couldn't figure out why they had no tax base. Because why? Well, nobody was moving into the town and the schools were declining in enrollment and this and that. So, yeah, they did that moratorium, and 3 years into the moratorium, every single one of the elementaries got rid of 2 sections of kindergarten.
Wow.
Because nobody could move into town. And what was most of the population then? Retirees that didn't have anybody in the school district getting STAR and not putting any more kids into the school district. Williamsville happened like that for a little bit too. You know, and then they're like, well, this isn't working. Yeah, duh. So now all of a sudden out there, you know, there's developments going up right and left. So, all right. It talks about, you know, which property class to use. Great example, built-in microwave for rental unit is considered part of the structure. Standalone microwave separate is an appliance, okay? So, you know, if I'm making something that, you know, capital improvements per se, that's becoming a permanent part of the structure, that's one thing versus, you know, putting something else in there, okay? All right, let's see here. We get into a little bit that listed property used more than 50% for business purposes is qualified property for the Section 179. We'll talk about that later, okay? And it talks about listed property. Because we have the option, if I buy something, and, you know, maybe you have a home office and you bought a printer, very nice one, special type printer that you want to depreciate. Well, are you using it strictly for business, or are you printing Black Friday coupons? Well, just a little bit. Okay, then I can't give you 100%. We'll take 75% for business. The other is for personal use, okay? Or I buy a double. Can I depreciate the entire building? No, 50%. So we have to be careful, and we have to use it for what is it used for? You know, what part of the thing that we're depreciating, what part of it's used for business or generating income?
For
Okay.
a double, you live in one.
Yep.
If you live.
Okay. Let's see. And there's some great little tables here on pages 14, 12, where you get to try to calculate each year's depreciation. But what it shows you is it shows you how, you know, the depreciation kind of starts out, spikes, and then levels off. Okay. On each one of those. All right. And again, I'm not going to, you know, that's not on the final test, Jim. You can cross those pages out for the final. Okay.
Where I thought it was.
Trying to figure out how those tables work and which one do I use and stuff. Okay, so section 179 is an exception to the, here's your gray, the exception to the general full expensing of an asset, okay? It allows the taxpayer to expense the cost of all or part of certain qualifying property up to a limit in the year that placed in service, rather than appreciating the asset over its useful life. So, section 179 doesn't mean I have to take the entire. I can say, well, I'm going to take 85%. And then depreciate the remaining 15 over its useful life. Okay? So section 179 gives you a lot of leeway to decide when you're going to expense that depreciation. All right? Special depreciation that we talk about next is basically it's set in stone that you take half of it in that year and then you decrease the rest of it. Okay? All right.
So if someone comes in, how we would know if we want to take it 50% versus.
A lot of times
try
I would,
both ways?
yeah, a lot of times with asset purchases, I won't designate until I get everything in. So I'll get their income in, all their other expenses. I might have put the depreciable asset in as far as the worksheet or the form, but I won't choose how much I'm taking until I see how everything works out and talk to them a little bit about how their business cycle works, when their income, when they expect to generate income. You know, I bought a drill press for my birdhouses. Okay. Well, are you going to sell any of these? No. Okay. So when am I going to generate income? Well, next year, because I'm building the birdhouses. Okay. Well, then, yeah, I'm not going to take your drill press that you placed in service and you're making birdhouses with, but it's just part of your inventory. I'm going to wait and take it, when you're selling these birdhouses that you use to the drill press on.
So they just hold on to that receipt and you can apply that receipt to the following year?
No, you have to put it in service. But what I'm saying is the depreciation that I choose to do, I might, go ahead and do a normal depreciation so that I have more for later years, as opposed to taking a special depreciation and front load. Now, if he bought this drill press because he's making a special birdhouse and this is the thing he has to have to finish them, to sell all of them in the year, well, yeah, I'm going to take them because when is it? All that income from those special birdhouses that I needed this special tool is all in this year. So I'm going to take them when they go together.
And once you pick the two, you can't change, right?
No, yeah, once it's set up. Once you've elected special depreciation or 179, you can't go back and change your mind. So again, there is a little art to it. But again, if you just boil it down to the fact that I got a pie of expense, when do I want to use the expense? That's all depreciation is. My first stipulation is when I placed it in service. My second one is what is its useful life, how many years? And then my third, I always do is it is now an expense. When do I want to use it? Okay. All right. And as it says there at the bottom of 1416, there is our order to apply depreciation. We always start with the section 179. Why? That's the most freedom. If it's eligible, I have the choice of electing 0 to 100%. Special depreciation, I have to take 50 and then depreciate 50. Regular, I'm pretty much set by those little tables that Jim didn't like. So, okay. All right. A couple exercises to do there, going through them. Okay. They really want you to learn how to do it by hand. And sometimes you have to do that. If I get somebody that comes in that was not a previous client and I have to put in depreciation in there, sometimes I got to go figure and try to find out what is the prior depreciation, especially when it comes to rentals. Or, God forbid, they didn't take depreciation. I've had that done where people have come in and I go, where's your depreciation? Oh, my previous guy never took that. Okay, we're going to now, and we're going to amend the previous 3 years, because guess what? You're still going to have to recapture depreciation whether you took it or not. So that guy cost you money for the first 20 years of your rental.
Because you can only go back 3.
Mm-hmm.
So at the end, when you sell this,
You're still paying back depreciation even though you didn't take it.
Like, if I sold it, and it was the end of its useful life.
And you never depreciated it?
100% of what I sell it for is going to be taxable income.
Yeah, it's going to be the basis.
So, and I got nothing for it.
And you left money on the table for the previous 27 and a half years. Nope. IRS says, too bad, so sad. Yeah, they don't give you the choice. They make the assumption that you did and you should have. And if you didn't, like I said, and I see that a lot come in, I'm going, well, where's the depreciation? Well, I just, when I bought it, I just depreciated the building. Well, did you make any improvements? Well, yeah. Well, guess what? We got to go back and recreate it because that's what you should do. That's the correct records and correct accounting. If you didn't, you know what? IRS is still going to ask you for that money back.
So somewhere on all this stuff, technically there should be either paper or some kind of record of what you've been doing for as long as you've been depreciated.
I would hope so. Good business would keep those records. So, and that's where, we've talked about, some of the things with the capital gain, selling mom and dad's house. Businesses, as long as you have your business, I would keep your tax returns. I wouldn't start getting rid of anything. Just because, you never know that you got to go back and find the basis of that thing you placed in service 15 years ago.
So, and then each year, like the prior years, it's basically you back in and calculate that line.
Mm-hmm.
The only thing that you really have to figure out is anything new that year.
Mm-hmm. But yeah, if it's something that somebody,
if you came in and
and it comes up all the time, I'll get a return and I'll be, even returns within our service, and something will come up and they're like, yeah, well, last year I bought, that refrigerator. And I said, well, did you tell them? Well, no. Well, let's go back and get it in there last year so we can use it for last year and this year. Because if we left money on the table last year, let's go back and get it. But recreating our depreciation is hard if you don't have a roadmap. Because if you don't know how, you look at all these methods, you don't know how they did it. Okay, they're depreciating. I got this number on this one form. How did they get that? What makes it up? Especially when you talk about a rental that's had a ton of stuff done to it. And if I don't have a detailed sheet, I cannot. Because I would, Johnny Carson, Karnak, I'd have to hold the tax return up to my head and say, oh, they use straight line and there's 10 items. I have no idea. Depreciation is hard to do that. So, and that's why we have you doing these little exercises with all the worksheets. Okay. All right. And we'll see a lot more of this depreciation when we get into the forms and the problems. Okay. 1425, we got business use of home. Okay. Again, I have two election methods. Okay. I have two election methods. I can elect to do it actual, or I can elect to do it as the standard. Okay. And again, it depends. All right. I get this a lot of times. I'll have somebody that is a landscaper or something, and they built this beautiful pole barn on their property attached to their house that they keep everything in. Okay. And they said, yeah, this is for the business and stuff like that. And I'm like, okay, great. All right. You got the motorcycle parked in there? Well, yeah. Okay. Is your wife's car parked in there? Well, yeah. Is she an employee of the business? No. Is the Christmas trees and the decorations in the rafters? Yeah. Well, then it's not all business. So you have to really pick it apart. They built it for the business, but when it's all said and done, half of it's a man cave and half of it's for business. And no, I can't write off the man cave just because they're in the business. Okay. So you have to really
So let's
make
say
sure.
you just kept inventory in rentals.
Mhm.
You just buy things and put it in there until you place it into service.
Mhm.
Nothing else is in it.
Then yes.
Then
And I have somebody that I do taxes for that on eBay and stuff like that does collectibles. and they have their basement is basically their warehouse of inventory. So yes, I can justify that because of, you know, they're not hoarders. They're just, that's all their inventory. So that's the business use of their home. You know, don't get kind of pigeonholed to where my desk is that I do business at. Just like you said, if I have inventory, yes. So.
My wife was empty in her basement. I got pushed out of the one little corner of the basement.
So then you can only do 90%.
Yeah. And again, you know, they give you $5 a square foot. Sometimes it's not a bad idea. But just remember, business use of home can wipe out your income, but cannot make you go into a loss. Okay, that's a big thing to remember on that. All right. Okay.
Business then on Schedule A?
What's that?
Can you put that, the standard, put up to the 1,500 on Schedule A?
For what? Home office?
Home office.
No, it's gone. On 17, yes. 18, no.
18's gone.
Mm-hmm. Yep. So if you're a W-2 employee and you have a home office, no deduction. Okay. All right. There's on the bottom of 1430, if you choose to do the actual, okay, and we'll talk a little bit about this. There's, you can see the two little columns with the small a and the small b that are direct and indirect, okay? Direct expenses relate only to that home office, home business area, okay? Indirect, that's where, based on the square footage or the percentage of the home that we're using, that's where, you know, real estate taxes, you can take a percentage. Good. Direct expenses, again, repairs and maintenance and things like that. I've had people, and I think I brought it up, that have argued that the bathroom that they put next to their home office was for the home office. Well, yeah, but there's a door that goes out to where everybody lives. You mean nobody can come in and use that but clients? Yeah, no. So can't go there. It's still indirect.
What happens if you put it on here, you have to take it off on your Schedule A?
Yep.
Will it automatically do that in the computer?
As far as carrying over, if you use the 8829, yes. Okay, so if you use that worksheet for the home office, yes, it'll split it between your business and take the rest over there. And that's where you have to be careful, because if you do somebody's personal return and you do the Schedule A first and you put all their property tax on there, and then later find out that they have a home office and do it that way on an 8829, you're going to double dip on their Schedule A. Because all of a sudden now you're going to have their property tax deducted full and whatever's left over from there. And I'll show you how that works when we do the software, but you got to be careful, okay? Because you can't double dip. All right. Talks about depreciation. You can depreciate your home for business, and it talks about the method there for that. And again, that's a little part on the Schedule C to use on there, okay?
People doing that more and more?
Yeah, they were.
Because more and more people are working
From home, but how many of them are W-2 employees?
Oh, I know my nieces.
Yeah, but now she can't. For 18, she can't write it off.
Wow. Surprise people.
Yeah, you know, and again, the look on Mary Ann's face, she's going, well, yeah. You know,
I mean,
they don't, you know.
It's 100% from her office.
The employer, you know, and if, you know, again, if the employer is really not wanting to have the cost of having an office or a building, and that's the way that their business thing works, that their employees, the W-2 employees work at home, yeah, 17, they could deduct that. You know, because a lot of people, what do? They buy the upgraded internet so that they can work faster and they don't have the interruptions, or a separate line, or have a separate phone line coming in. And if those are things that are not reimbursed by the employer that they have chose to do to have a home office, 17, they could deduct that. 18, what happens? It's gone.
We just learned that for nothing.
You're kind of getting that feeling that there's a little bit of that?
Well, but it might be on the state, right?
Yes.
So,
Yeah, so you can still
so
do it on the
we're,
state.
that's why we're going to learn.
Still learning.
Okay. All right, let's take 5 minutes. We've been going at it pretty hard before we do clergy. Okay. All right. Everybody excited about doing depreciation?
Oh, yeah.
So, yeah. Yep, I'm going to give you a rule and we're going to do it 10 times and then I'm going to tell you not to forget that rule because we're going to do it a different way. So, all right, clergy. This one's even more fun to read, okay? Because clergy, I don't know why they stuck it in here, but I guess they had to put it somewhere because why put it with depreciation? But most clergy are W-2 employees, but they do not pay Social Security and Medicare, okay, out of their pay. Plus, they have a housing allowance. So, I think I gave everybody the little cheat sheet for clergy, right?
No, you said that you're going to.
Did I not make copies of that one?
You
I thought I gave it to you.
said that you wanted to give us an example or something like
Well, example on the problem, but I thought I gave everybody the.
that. What does it look like?
It looks like this. Has some funny little writing at the top, real light.
Oh,
I think I gave it out when I gave out the 1099R stuff.
Yep, we have it right
clergy
here.
cheat sheet.
Yep.
Yeah, clergy cheat sheet.
Yeah, that's the
Okay.
clergy.
No FICA or Medicare tax withheld. So basically, when you have a member of the clergy, you'll get a W-2, and it'll have something in box 1 and box 2, and all the other boxes are empty. And then it'll have something in box 14 that'll say housing. So that's really what this applies to. Okay.
Does our housing stay as income?
Yes. All right. And on the bottom of page 1432, there's a little spot for clergy, and there's notes. All right. I want you to write C, office supervisor. Okay. Because the first one you go through, you got to do it with somebody that's done it before. All right. It is very hard. Even with the instructions, I still pull out my instructions every time to make sure I don't miss anything. Because there's 3 hidden minister worksheets that you have to do. So when you get into the offices, you're going to have a practice problem. One of the 20 problems, it's going to be a clergy, and you'll do it hands-on with the new software. And I want to make sure, too, that I haven't picked that one apart as to how the clergy is handled on the new software. So before I say how we're going to do it or do a practice problem or anything, I want to make sure that I'm not teaching you something that you're going to have to forget.
So they're not going to get Medicare and they're not getting Social Security when they retire?
Only if they pay self-employment tax. Most of them do not.
Right, so most of them do not pay self-employment tax, which means they're not going to get Medicare
Yep.
or Social Security.
And if they have a vow of poverty, they don't have to pay self-employment tax.
So then how are they going to get their health care?
Hope the church takes care of them.
That's why now I understand why we're always getting special collections for the retired.
Missionaries and stuff? Yeah.
So that they don't have them.
Mhm.
They never paid into it.
Yep. I was a trustee at a church, and that was one of the big things. And, this is probably 6-7 years ago. And, I kind of told them, you guys got to start planning.
Well, can't they go in the marketplace?
No, because they're over 65.
Once you get to 65, then they're going to assume that you should get the Medicare. You can't go to the market.
That's right. So you have
Even if
to.
you didn't put enough quarters or anything like that.
That's right. So now you have to pay to get Part A, B, and all your things. So you have to pay for A, and you got to pay for B, and you got
Or
to pay
pay
for
for private insurance, like
Yep.
independent health.
Mhm.
Blue Cross Blue Shield.
Yep. Or pay. Yep.
Can you still get private insurance not through the marketplace?
But most people, it's silly because then you don't have the eligibility for the subsidy or credit to help you pay for it. You can go directly to a Blue Cross Blue Shield and buy the insurance.
They charge you the same as.
They're going to charge you full price, same as it's in the marketplace, but they're not going to allow you to get a subsidy or credit.
But if you're 65 or older, you have no choice.
Mhm.
If you can't get Medicare.
Mm-hmm. You're paying full price. Wonderful system, isn't it?
I mean, I'm on it, but how much is it if you gotta pay the full shot?
For A and B,
Yeah, just curious.
I'd have to look up the premium for A for now. But yeah, there are people that have to buy it as if they're buying insurance because they don't get the free A and the reduced B and free D that they would normally get if they've paid their 40 quarters. So if you don't pay in, you don't get to take out, Jim.
No, that's fine. I'm just was curious how much,
It's not cheap.
well, I'm just curious.
Well, there is. Here's essential. It's $20 a month, but talk about a vow of poverty. So in order to get that, you got to try to figure out how you're going to live on as an individual on $24,000 a year or less. Well, on paper, yes. So.
Want to, but you can.
All right. Self-employment health insurance deduction. We talked about that in the adjustments. Okay. All right. So that's an adjustment that we get to take on there. All right. And we have self-employment tax. Okay. So on the top of 1436, self-employment tax. Again, that's where you're paying your Social Security and Medicare on the tax return because you did not have it come out of your paycheck, okay? And it's based on your net income, not your gross. So that's where a lot of people are so adamant that they don't want to show a profit on their business. Okay, that's great, but do you realize that's 4 quarters that you didn't pay into the system? Okay? And as it says there, the self-employment tax rate on net earnings for 2017 is 15.3%, okay? And if you look at the form, you first take it times 0.92 and then the 15.3 divided by 2 to get the deduction.
Is that the same for 2018?
Yes. Okay. So you can see down there, it talks about, you take, the Schedule C, the net profit, determine 92.35 of the self-employment tax, determine for half of it, after you do 15.3%. So, most of the time, if I have somebody that says to me, I need to make estimated payments, I'm self-employed, first thing I'll say to them, what do you think your net profit for the year is going to be? So those quarterly estimated. Then I'll take it and say, okay, $10,000, multiply it by 0.92, take it, times 15.3, that's their self-employment tax. So that's what they should really pay. And if they have no other, ways to lower that tax, they don't have any earned income credit, things like that.
How did they come up with the 92.35?
What's that?
How did they come up with that 92.35? Is this a given?
What it boils down to is they're kind of backing you into what happens for the employer. So if you're an employee as a W-2, the employer is what they have to pay on is 92%. So they get a little break. So, self-employed person gets the same thing. So, okay. All right. Okay, so a lot of calculations. Again, it's just knowing how to do the calculations on that. All right. You got a little problem there, a little example where the Smiths have their little plants for you business. You get to, calculate some depreciation and all that fun stuff. Okay. All right. So that's chapter 14. So let's get into some problems here. Okay. All right. Now, let's see. Before we do that, Marianne, I think you might have questions in 12 and 13 on some problems. Or do you want to know the answers? Yeah, I'd have to go back and look at it again because I sent it in there because of the.
I'm not getting anything from you. Should I be?
Yeah.
Yeah.
Email?
Yeah.
I have you in a distribution from, let's see here, what is it? You might be going to junk.
I check that pretty regularly. We get a lot of junk.
You never know. One
It's
thing.
important stuff.
I have abrasiveguy@hotmail.com.
Yeah.
Yeah. I'll check my distribution thing because I just have them in as a group. So,
Okay.
but I will check it. Okay.
What, will it be from you?
Mm-hmm. Well, it might say online instructor. Sometimes I'm in my my email for because I send it out with the stuff I do for my online classes. I'll send it out as instructor stuff from there. So, all right. Okay, yep, because that was the one we did for 12-1, and 12-2 is the other one was the Partridge Family. Do you want the answers? Partridge Family? I give you.
Give that to us, 87819.
Yep. Okay. And then we had the problems in 13.
Yeah.
That kind of perfect family.
Mm-hmm.
What do I got? 261 and 8. Remember, I had 190 here that you told me. I couldn't figure out what it is.
Let's see in the bullet.
Yeah, I don't have the correct. What is it?
For the state?
73 and 275. I think all three of us had different figures on that one.
On the Partridge?
Yes.
Yeah. And the federal I had agreed was 878, but I had 261 and not 190 on the state.
You have 190 on the state?
No, I don't, but you told us the answer.
Right.
190, but
I have 1,073 and 275, so. Maybe that was the one that was-
878. I didn't, New York State.
Okay. And you got the, let's see, this one, did this one have the, and you got the state, you got the New York State Disability off there, the 3120, correct?
On what? On the
The one W-2 there for Xerox Corporation?
3120? And put it on the Schedule A?
Yes.
Say that again.
On the W-2 for the Xerox for David, there was $31.20.
What line would that be on?
Well, if you put it in as New York State Disability Insurance, it should be carried to the state tax paid, line 6. But if you didn't put it in that way, then you would put it on line 8.
For other?
Mm-hmm.
And I can put it there.
Okay.
But no, I did not put it in.
Okay, so the federal's okay there, but your state was off by how much?
I had 261, so 71 bucks.
You have 261, I have 277. But I'm still off on the federal.
Okay, let's take a look. We do any more problems here? All right, so let's do Pierce here. We'll kind of go through it. This is for Alexander and his daughter Alexis. He is self-employed. Doesn't itemize. Deductions.
He's a widow.
Alex is widow. His wife died in 2016. So what are we doing for filing status?
Widow.
Head of household.
Oh, right.
Yeah, that household or qualifying widower.
I did qualify.
Whoops.
So we can kind of see which one that works out. You got the information. They had health coverage for the entire year. Alex is self-employed. Hey, birdhouses. Gotta love the guy.
I know when you said that.
Yeah, I was like, finally, we got this guy.
I keep bringing up birdhouses, and you're like, he always talks.
We made a lot of money off of that.
I told you, there's money to be made there. If you do them right. Haven't you ever seen those? I guess they're not really birdhouses. They're kind of like bird condos, those big things. High rises, the ones that got about 50 holes in them. Okay, so we have, so let me get them in there real quick and then we'll go through and see where we have. Yeah, I'm just not sure why. That's kind of odd that yours is calculating Schedule D different. And I'm not sure why Jim's is calculating it different, so. Well, he wouldn't have any clue on that one. You need a forensic accountant on that one.
I had getting the earned income credit.
$200 for the expenses. Went down. Yeah,
Self-employed.
mine went down to
We're going to start out with them as head of household right now. I'm going to do a head of household first, okay? And then we'll mess with it as far as the qualifying one. Yep.
So the white guy the year before.
Right, but you're supposed to be able to take it for the 2
Mhm.
years,
For 2 years.
Mhm.
right? So
Yep.
16, 17. Can you take it 2 or 3?
2.
2, okay, so it'd be 16 and 17 then.
Okay.
So if I just change head of household right now, can I change that on mine? Or keep it alone? Because that will change the whole thing, wouldn't it?
Yep, give me 1 second here. So let me get stuff in.
You did head of household?
Make sure I'm losing my mind. Yeah.
Let's see. 24, but did not itemize. They had health insurance all year long. Okay. So Alex is building birdhouses, so he's got a Schedule C, right? All right. Okay. I wouldn't call that construction. Let's call them birdhouses, right? What did you come up for a business code number?
56179.
Okay, that sounds good.
Wait, business code?
Mhm.
I came up with 337211.
I did the district, the Google.
I did.
I
put in
did
birdhouse.
Google it. I did.
Okay, what did you have? 5-1?
I had 561790.
Sounds good. All
Is
right.
that right?
Sure.
Well, I put the wrong one then.
What did you come up with?
337211.
And what was that for?
Building birdhouses.
Maybe that was the designer bird.
Okay, so he had income of 30,476, correct?
Right.
And he had some returns for dissatisfied customers, right?
133.
133. Okay, so return allowance is there on income part 2. Okay, so if I go to my Schedule C where it says income,
Oh, yeah, number 2.
returns, yeah.
Yeah, okay.
Part 1, line 2. Okay. And then on the other side, his next little part of the paragraph says he had the beginning inventory. He's using the cost method. His beginning inventory was 593. So I'm on Schedule C, page 2. All right, no changes there. And he purchased materials and supplies of 11,000.
335.
Mm-hmm. And his ending inventory was 817. So his cost of goods was 111111. One? Did I see enough ones there? Okay. Expenses. So on a Schedule C, we have advertising. He had $150. Page 1. Yep. Part 2, expenses. He had some legal and professional services on his tax forms, $275. He had cell phone. I like to put that on page 2 on the other expenses. Okay, so we've got cell phone, $720. He had taxes and license. He had a business license of $55. He had some supplies that are not in part 3 of 1874. I put that under supplies, the nail, glue, sandpaper, and paint. And then we had postage boxes and supplies. I'm going to put that under office expense. Did you put it on the other expenses on page 2?
I put number 18 of office expense.
Okay.
Anything else? You're off the
Sales tax collected. What did you do with that?
Nothing.
Website?
I put that on other,
What's that?
27A.
Sales tax collected?
No, sales
Oh.
tax collected, he sends it out.
Okay.
It comes in and goes out, that's the state.
Mm-hmm.
I did the website on 27A.
I put it, I added it to advertising, because I thought it was like yellow.
Okay. 8645
Well, where'd you put the nails, glue, sandpaper, and paint?
supplies.
Instead of,
Line 22.
No, as long as you're consistent.
I put postage boxes and supplies all that together. I mean, sandpaper is a supply. They're all supplies. You want, instead, or office expenses.
And let's see. Maintains a separate small building for construction of his birdhouses. The building has 225 square feet. He has a separate electric meter for the barn and bills totally. Okay.
Which page are you on?
I'm still on 13.8 at the very bottom. So for his, on page 1 of the Schedule C, I'm going to go to that simplified method. All right. And it doesn't really say how big his home is, does it?
No, that's why I wasn't sure to put that's where
Yeah. Okay. So we're just going to say 1,500. And we're going to say that he used 22.5 for 225, I should say, for that. And then we had utilities because he has an electric bill there for 1245. Okay.
Wait, where'd you put expenses for business use at home? Where'd you get that 1125?
225 times 5.
Okay, so you're just putting that 1,500 in on it.
Yeah, I just made it up. He's living in a big birdhouse.
Think that a separate building. You don't,
And the 225 you came out with was the square footage of the home.
but there's nothing, it's a separate building.
Okay.
Okay, so
So
mine,
it's not part of the home.
for the 170, I know, that's what I didn't understand too.
So can I put it in there?
No.
No.
We gotta take it back out?
That's why there's no square footage of the house.
Oh, that's why we have it in here.
Mm-hmm. But what about the utility?
That's all his business, because it's separate meter.
But I'm still getting a
Okay.
different
Put that in
31 than you were.
Okay.
25, 12, 30.
So what did you guys have for gross income? Line 7 on your Schedule C.
19,232.
19,232.
How come you got 19,502?
Because I have dyslexia.
Okay. Okay.
19,232.
So you have that.
Okay.
Then I had,
Total expenses.
okay, wait, which number is that?
Line 28.
11,054.
Yep.
I have 6429.
What?
I know. Okay, let's go back. I'm
Okay.
advertising, you can do advertising.
Yep. Go to, what do you have for business miles?
Business miles. Pretty good number.
Line 9.
25?
Line 9.
Yep.
Oh, see, I don't have anything in it. It didn't carry it over. I went
Okay.
and
Go
checked the
to
other-
your Schedule C, page 2,
Okay.
and read the little red writing right there. After where it says business A, then there's a little red writing. What's it say?
This is business A.
So line 44.
Line 44.
Yep. And
Oh, I gotta check
Check the
the
box.
box. I gotta check that box.
Tricky.
Okay. Now I gotta go back
okay, now go back over and see what it did.
on schedule C. Right?
Page 1. Yep.
Line 9 again. 4625.
Yep. Okay. So what do we have for a total on line total expenses on 28? 11.
11,054.
Okay. Now you're good. So what do you have for your refund, Jim?
2,128.
And state?
1,006.
That's what I got.
Why?
That's what I got.
But that's not what you gave us.
Yeah. So the answer key's wrong again.
No, he gave us 945 and 521.
Oh,
Yep.
yes, you're right.
So, yeah. So,
He keeps giving us wrong answers.
I know.
So I can
We
put-
should work.
I can put a smiley face on my problem.
you can put a smiley face on that one. So, all right. So we have that. Okay.
I would have gotten it if I just checked that box.
Mhm.
Because it didn't carry over.
That's correct. Yep. So you got to be careful on that
And
one.
I'm
Make
okay
sure.
if I did the 18 for all the business or the nails, those two boxes, and put it all in the same schedule.
Yeah. I mean, I would rather see you do it as supplies instead of office expense. So,
So they're all supplies instead of office expense? Or
no,
is it
because the
boxes?
postage could be in the office expense.
So, or office expense and.
Mm-hmm.
What is it?
The filing status,
Okay. Let's try it different.
well,
I still.
how did you guys do yours? Qualifying widow?
I did qualifying widow.
I had a household.
I did have a household.
Is it?
Qualifying widower?
No,
Same answer.
It's the same answer.
Same answer.
Well,
It
I'll
qualifies
be
for both. What's that?
Will it always be?
Not necessarily, no.
Okay.
So, okay. All right. So let's move into 14.2 because now we're going to buy some depreciated items.
And same
Okay.
person?
Same person, same problem.
Oh, okay.
Yep. So if you go to 14.2, we have Alexander Pierce.
Oh, yeah.
All right. So
Birdhouse guy.
the birdhouse guy. Yep. And look what he bought. Some things to,
Oh, he's getting real involved now.
yep. Yeah, it's getting elaborate. Okay. So we're going to go on to our Schedule C, page 1. All right. All right. So Schedule C, page 1. And if you look at line 13, what is line 13?
Depreciation.
Yay. Okay, so go over and light up the box, hit F9, and tell me what's in there.
$1,962.
Okay, so
562.
we're going to do that depreciation. Don't say worksheet, it's just a form. Okay? Now, guess what? This is like our Schedule B and our Schedule D. Put this on your list of, this is the form I use, but I put absolutely nothing on it. Okay? So, see we're on 6A, it says description of property.
Yes.
What's the next line read, Jim?
6.
Yeah, six little a, it says depreciation of property. What's it say in red underneath there?
For accurate computation, F9 to worksheet.
I like the words accurate computation, don't you?
Yeah, sure.
Okay.
Inaccurate.
As opposed to inaccurate, if we had a choice. This one. So we're going to light up the little box right below there and hit F9. What's on there?
New asset worksheet?
Yep. All right, so open that guy up. Okay. This is where we're going to do all of our depreciation, is on this worksheet.
I knew there was going to be a worksheet.
All right. See, we're doing depreciation. We got vehicles. Look at the gray boxes up there. And what's that third gray box? And we'll talk about it a little bit more next time when we do, because we see this box a lot more when we do sale of rentals. That's where we sell it. Okay. But this is the worksheet we're going to work off of. Okay. So what's the first thing he has there? Table saw. Okay. All right. And then if I go to my asset type and I go in that field, what pops open? Okay. All right. What do we have here? He has, if you start looking through these, data handling equipment. You think this is a little outdated? That would be a computer. Okay. Okay. If you're doing goats and sheep breeding, hog breeding, if you're doing horses. I did have a guy one time I was doing horses for, so. Not the guy that was training them, but a guy that owned horses. Some talk about Indian reservation stuff and, drilling cost, land improvement.
How about equipment other?
How about machinery and equipment other? Perfect. Okay. Yep. No gray there. When did he put it in service?
That was June 1st.
Okay. So 612017, right? Whoops. I typed it in wrong. 61. Whoops. 1. Okay. All right. Now, if I take a look right now based on what it is, I want you to go in the section that talks about depreciation, amortization, section 179. Okay? If you look down there, what is the recovery, what is the method that it defaulted to?
Mackers?
Mackers, yep. Okay.
7 years.
7 years. And what about the convention? Half year. Okay, so see how it does it for you, okay? But I want you to always pay attention on that, knowing that, because what happens if we have things, you know, this case, we have everything kind of in the middle of the year. But what happens if I had it where it was something different? Yeah, when I had that one like we saw with the apartment, okay? You'd have to make sure you did it. All right, so what's his cost there?
3440.
Okay. All right, so we have that. And it says up there, he would like to depreciate them over the allowable year for new equipment. What turned red on yours after you put that in?
Special depreciation.
So this would be eligible for special depreciation if I wanted to take it.
He doesn't want to.
Yep, he's not going to. And is it section 179 eligible?
No.
No, it kind of already did that for you, didn't it? Because sometimes, you know, depending on what the asset is that we're doing, you might have the option between the two, okay? All right, so we're gonna say no, all right? So we have our first depreciable item in there, all right?
Oh, wait, it does say eligible. 179, section 179.
Yep, so you could take it.
It says yes.
We'll talk about that in a second. We're not gonna do it, but we're gonna talk about it in a second, okay? All right, so we got that one in there. So because he's doing straight line. So just like we do with W-2s, you can go right up to the top so you don't have to do that whole use the 40, yep, copy the asset worksheet. All right, and what's the next thing he's got? Cable sander. Okay, and what are we gonna put this under? If I hit M for machinery, since we know that, it goes to machinery and other equipment. When did I place it in service? I get myself out of the way. June 1st, right? What? 6/1/2017 again, okay? So 7 years because of the asset type that we took. And what did he purchase it for? 1,700, okay?
You want the special again, isn't on it.
Nope, and he doesn't want to do the 179, okay? And then enter the next one. We got a drill press, so you're just going to go up the top to the little white tab. Copy that. We got the drill press. We have machinery other. We have June 1st, 2017. And he spent $1,354. And again, no special, okay? Last one is a paint tent. He's really getting elaborate. And I would do that under machinery also. Okay. He spent $550, okay? Now, what was his refund prior to us doing the depreciation?
2,000.
Okay.
2128.
Okay. What's his refund now?
1807.
But we added expenses. How does his refund go down if we added expenses and decreased his profit?
Darn good question.
Why would I ask if it wasn't? Is that what you're telling me?
Were they in?
What probably changed, if I look at his AGI, what's his AGI now?
His AGI now is 6,664.
So
That's because that went down.
I decreased his AGI. What did I end up decreasing for somebody that's a head of household?
Is there an income credit?
Because that's where all of a sudden I'll get people where there's doing returns, and I'll be doing the return like this, and they'll go, well, I don't want to claim that now. because now my refund's smaller. No, you have to claim that. Why?
Next year we'll get it back. It won't be as, no, maybe greater next year, so you won't get it back
Well,
next year.
but they're all of a sudden saying, well, I want more earned income credit. So I don't want to take the expenses. You got to change it. Once they're told to you, you can't. You can't be fudging the numbers to increase your refund to get more.
They don't have a choice.
Oh.
They can't choose to say, fine, I'll just eat my other costs up.
Mm-hmm.
Why not? I mean, it's.
Yep. So I'm going to do a little what if here. Okay, you guys don't have to do this so that you got it. So I'm going to do a little what if. And I'm going to take that big ticket item, is table saw, and I'm going to take special depreciation. Okay. All right. I just cut his refund. Yes, he's going to be paying less self-employment taxes, but I also cut his refund to $1,333, down from $1,800. Because the less income I have, the less earned income credit I have. So self-employed people kind of can't have your cake and eat it too. Oh, I don't want to pay tax on my profits. Okay. Well, what happened to my refund? Well, you don't have as much income or earned income. You don't get as much earned income credit.
Mhm.
But, you know, if you have depreciable assets, you need to report them. Okay. Now, on this too, if I say no on the special, and I'm going to go down to section 179, okay? See the very bottom where it says line 5, 179 election amount for this property? I can put any amount I want in there. Well, I'm just going to take 1,000, okay?
Oh, yeah.
Yeah, down to the very bottom. So I'm putting 1,000 in there. Whoops. Okay? So I got that in there. But again, I'm leaving the rest. Now, what I want you to notice is when I did that, and I take a special depreciation, notice how the worksheet works, okay? So I'm taking 179, so I'm taking 1,000 in expenses this year, leaving me what? What now becomes my basis for depreciation going forward? See how that worked? Instead of 3440 up here, I have a different basis.
So what's the refund on up there? Is it 15 is the same?
Yep, 1536.
So you'd still be better off doing it the way that you wanted to do it.
You know, in a case like this, and where his income's at and stuff like that, I wouldn't take any special depreciation.
Because it's, yeah, his income's relatively low, right? So it's not saving.
Yep. Not saving a whole lot. Okay. But see how you can, you know, again, this is how you can manipulate those numbers if they're eligible. All right. Okay.
So the 179 there lowered the basis because you took it.
So I took 1,000 kind of as a upfront.
So you gotta take it off from that.
So now for the remainder, I'm only going to be able to depreciate 2440 because basically I cut my 3440 pie, took 1,000 in the year, and then I depreciate the rest. So I get my 1,000 plus the depreciation.
So if you threw 2,000 there, it'll only be
So
1440.
you still end up with the same, eventually the same
Total depreciation
total, right?
over its
And
life,
just
yes.
earlier.
But so I took 1,000 plus I get 349. Okay. If I do that, you know, Mary Ann was asking about the 2,000.
2,000, you see what the figures
Okay. So now if you look at it, I have 1440 depreciation, but I get the 2,000, but now I have 1440, so my current year is only 206. So I actually get $2,206.
What's his refund? 13 now?
1266.
All right, so that goes down even more.
So it's, yeah.
So it's not always
If he was
good.
making lots of money, it'd be
good.
But it's,
So you can see how you can manipulate the refund. You know, and that's where you say to them, well, you know, we're in a good position and you're going to leave some of those expenses for future years. I can't say to them, hey, you idiot, why are you going to decrease your earned income credit? You know, my advice to him is, you know, let's take the expenses and use them in future years and reserve it for that.
With
So
all
we
this
could've-
equipment, he's gonna be selling birdhouses left and right.
Sounds like he's got good business going.
So we could have taken this, the table saw, all that stuff, and say, let's wait till the following year to take that.
No, because what I'm saying is that we have to still take it as a portion in the first year. If I put it in service, I have to claim it. I can't wait till next year. What I'm saying is, as opposed to front loading it with the section 179 or the special, I'm gonna wait and
We
just
have to
use
do
it.
it one way or another, so let's do it,
Exactly,
that he gets at least a better refund this year,
exactly.
and he'll still have more to work with next year, 'cause he'll probably have more income.
Yep, and you can see with the makers with what we're doing, you know, starts, climbs up, and then kind of flattens off. Okay? All right? So again, that's what depreciation is. You know, it's kind of daunting when you first read it, going, man, this makes no sense, and I need to be an accountant. But again, you know, if we can figure out how to use the depreciation and how to expense it, because we're basically creating a budget for the year, the 7 years on this one, in this case. Okay? All right. So, but I'm going to take the what if off there. So if you want to write down your answer for 14.2.
Yeah, 1807.
1807 and 863. Okay. All right. So basically, 14's problems are really easy. You're just going to have fun with depreciation, putting them in. Okay. So if you look at 14.1, we got Barbara Young. Okay. So I'm going to talk a little bit about each one of these. Oops, let me get this. No. Okay. So I have Barbara Young purchased a printer, copier, scanner, better known as data handling equipment. Does that make you feel old, Jim? Okay. And make you feel like you should be feeding punch cards into it or something? For $16.99 on April 14th. She used it 90% for business, 10 for personal. And she'd like to take it over the allowable years. Okay. All right. Okay, so what's that mean I have to do? If I take a look at the one I have on the board up here, take a look at line 1C. Okay, so see what I have there? What's 1C say?
Business use.
Okay, so, yeah,
They go to the other one.
if I put business use, what,
90.
well, I put 90%.
So
Okay.
we'll change that, so the 100% will change to 90%. So we don't have to figure that out in our head or on paper, that we'll figure it out on that.
So I use 90% for business, right? So then it's going to give me 90% there. All right. See how I did that? See that, Jim? And that's where, too, when I have a double, you know, what am I going to put in there if I bought a duplex? I live in half and rent half, 50. Okay. All right. So that's where you got to put those in there. 14.3. Okay. Going to be a little bit of a challenge, but I'll let you do that because he did some things that qualify for 179 and special depreciation once you kind of manipulate it. Because see, he bought what? A non-residential building.
Oh, wait.
Okay. So we're going to depreciate that as an asset. When we look at our choices up here,
He's 7.5.
yeah, we look at our choices up here. we have real property, non-residential. Okay, and typically that's depreciated for 39 years.
39.
Mhm. Okay, so we're going to kind of do that, and then we're going to do other asset worksheets. And now that's where you do a little bit of, you know, financial planning, saying, okay, we got that income. He's already got a loss, but to minimize his loss, because, you know, he was the one that had the huge balance due. So what might we want to do? But paint, what are we going to do with paint?
What are we gonna do with it? Put it under machinery?
Paint, it's just paint.
Oh, I was gonna say, then you can put it under supplies or something.
Mhm. It says on here, okay, he did the
Oh, I'm sorry. I thought you were on that part.
14.5. So it's paint.
14, paint.
What might we want to do with paint?
Are we gonna, because he said he,
Can
Yep.
be 5.
oh. Well, don't we add that to the basis,
There you go. Good.
right?
Wait.
'Cause he's,
Oh, because it's permanent,
He's-
then he's painting the building, it's not painting. Oh, okay, I have to ask that question.
Yep. Good thing, because what really does that do? It's part of the basis.
So that paint is not to do something else with it, it's to paint his own building.
So we're going to add that to, yeah.
he's insurance, he's not, yeah, he's not a paint salesman.
Yep. Okay. And but then the sign and the awning, what about that?
That's advertising.
Keep thinking along the line you were, Jim.
I'm not still added to the basis.
Exactly.
I mean, it's-
Mhm.
So there's gonna be,
He's trying to open up the
Permanent.
business. or
Yep. So
whatever.
we're adding that to the basis. Yep. But office furniture and computers and printers, what are we probably going to do with those?
Expense.
that's gonna
Yeah,
be-
I'm going to take, well, no, not as an expense,
No,
but I'm going to see if I can do section 179 and special depreciation with those. Okay. Because those are things that would qualify for that. See, I'm spinning them out because the sign and awning and paint, they aren't going to qualify.
they're gonna be permanent.
Exactly. So they're better to roll in the basis. The other two to split out as other assets and see if we can do a section 179 or special depreciation with them.
So if you put that in there, then it goes under cost or basis.
Yes,
4,319 instead of going.
you'd add that to the 33,000.
And you would manually add it to it and then put that into it?
Yep.
Okay, so there's not another thing that it's.
No.
an addition.
In other words.
No,
he had-
no.
Another word?
Nope, just you just have to know that you create a basis on it. And then, you know, obviously somebody'd have to have record, but yes. But you would just make it part of the cost or the basis. Okay? All right.
Then that would go on that 1A or whatever.
Mhm. Okay.